There's a lot of press about service charges and shared ownership, and a lot of negative press about shared ownership.
When buying a property through shared ownership, is it a different process with the mortgage than if you're buying, say, a normal property?
All of these things will have an impact on what type of mortgage you're able to obtain.
Okay. What kind of costs can people expect to pay when buying through shared ownership, and what ones can kind of catch people out sometimes? Hello and welcome to Shared Ownership Unpacked. I'm Joe Bartlett, the home buyer coach, and I'm joined by Rob Horn from Southern Housing.
And today we're going to be talking about the financial and legal part of the shared ownership journey, the fun part, the bit that really the serious part, but it's definitely fun, and it's a very important part of the journey that not as many people talk about. So we've been joined today by Anthony Hall. Anthony, you're the independent financial advisor for Censeo Financial. Is that right?
I am. I'm a mortgage advisor. I'm one of the directors at Censeo Financial.
Brilliant.
And we specialise in shared ownership.
Fantastic. Thanks for joining us today.
Thanks for having me.
It's a pleasure. And before we dive in, you've given us a tiny amount about you and your role, but give us a bit more of a background on you and where you've come from in terms of your history in housing and how you got to be where you are today.
So I've been at Censeo Financial now 17 years.
Wow.
Actually, this month.
Happy anniversary.
Congratulations.
Yes. So 17 years last month. I actually joined in 2008, for those who can do the numbers, during the credit crunch.
A big year to join the financial.
So probably not the best time to join a mortgage business. But prior to that, I'd worked in banking. So I worked at the Abbey National at the time, for those who can remember the Abbey National, now called Santander. So I worked there for a number of years, and I wanted to get into mortgages, but didn't fancy the route of working as a mortgage advisor in branch. It just seemed a bit dull, to be fair, working in the branch, and the person who was in the branch I was at wasn't the most exciting person, so I thought, I don't want to be like him. I think I want to
be a bit more fun.
Yeah, I want to get into brokerage. That seems fun. So I've kind of gone through the ranks. So I've been an advisor, progressed to sort of team leader, sales manager, became a director probably about 6 years ago now. Brilliant.
That's a really good story, and one that brings a lot of experience. So we're looking forward to what you can tell us today on the podcast.
Yes, I will try and give you all the good, the bad, and the ugly.
More of the good, less of the ugly. So this segment's named after Quaxley, and it's called Quack Attack. And basically what it is, we're going to give you 20 seconds to answer a question that's quite an overarching question. So we're not expecting you to be able to cover everything in 20 seconds, but the challenge is, can you try and give us as much information in 20 seconds as possible? So your Quack Attack question is, in 20 seconds, can you say what are the most common legal/financial mistakes first-time buyers make?
I would say, number one, people generally get their income incorrect, believe it or not. So they think they earn £45,000, for example, but actually they either earn more or less. And that can range. Sometimes it's £1,000 more, it could be £4,000 more. Or they don't realise that they've got bonuses or commission.
20 seconds is up. That's pretty good, though. I feel like there's a lot more to unpack
I could carry on talking forever. I didn't even touch on the legal side of things, to be honest. But
we'll dive in deeper, don't you worry.
So as a first-time buyer, what's the first step financially that they should take?
I would always advise people to start your research, and that starts with understanding your affordability. So know your numbers. Go through your pay slips, know exactly how much you're earning. Go through your credit report, see what your commitments are. Once you've got that Excel together, or Google Sheets, I don't want to, for those
other spreadsheets are available.
Spreadsheets are available, yes. List your outgoings so you can see a budget. Once you know what you can afford, that gives you, the way to go. And you wouldn't go and buy a car without knowing what your budget is. So it's the same principle. Understand what your outgoings are, know what you've got coming in. If you've got disposable income of £1,500 a month, then that's what you can allocate to your housing cost. then you can start to look in the market. That might determine what area you even buy in and where you look.
Okay, and I suppose speaking to a mortgage broker, that a broker can help them with that process as well, with the kind of affordability, the budgeting.
Most definitely. However, I would recommend get that ready before you even speak to the broker.
Okay.
Because yes, the broker can help you, but the tip that I would give is get your last 3 months bank statements, go through that, list all of the things that are regular occurrences. Your direct debits and standing orders are quite easy. You can pull those out. But it's those little things. So, how many coffees do you get in it every day? Do you have a little fascination with a McDonald's every Friday? And is that adding up?
Yeah, exactly
that.
Okay, good to know.
When buying a property through shared ownership, is it a different process with the mortgage than if you're buying, say, a normal property?
There are some different steps. I wouldn't say the actual mortgage process is particularly different. It's the initial process before you start the mortgage is different, because you have to be qualified financially to be approved to buy via the registered provider, whether or not that be a housing association or a local authority doing shared ownership. So we as brokers will qualify to make sure you meet the eligibility. So that's making sure that it's affordable under what they call their guidance. That's either the Capital Funding Guide, or Homes England guidance. But then we also need to make sure that you can get a mortgage as well. So we'll approve you to go ahead. So there's income caps as well. So you're under the 90,000 if you're in London. If you're outside of London, you're under 80,000. So there's those checks that need to be done before you start the mortgage. Once the broker's done that, the actual mortgage process in terms of submitting the application to a lender, doing a valuation and getting a mortgage offer, and the underwriting. So when we submit the application, we've got to send documents to the lender. All of that is the same. That is no different to buying on the open market.
So I suppose then there's two affordability assessments that take place during the purchase. You've got your initial one, the assessment for the housing association, and then you've got your second one with the actual mortgage application.
Exactly that.
Okay.
So it's a two-stage process. That's why from an affordability point of view, if you get past your housing association check at the beginning, there shouldn't be any reason why, if it's done properly at the beginning, you should have any issues with a mortgage.
What kind of costs can people expect to pay when buying through shared ownership, and what ones can kind of catch people out sometimes?
So generally there are different costs at different stages. So there will be some fees that you potentially will pay to the housing association or local authority to reserve a property. And that typically is refundable if you don't proceed. Give or take, that fee does, what would I say? It does change depending on which provider you buy it from. It fluctuates.
Yeah.
That's the word I'm looking for.
I got you.
So you're looking at about maybe up to £500. It's very rare that you'll see it go over that. So that's called like initial reservation fee. Then you start looking at sort of broker fees and lender fees. And then you've got your legal fees after that. So solicitor fees typically are based on the value of the property that you're purchasing. So there'll be a range, but give or take, I would say an average fee on shared ownership is about £1,500 to £2,000 for your legal fees. Mm-hmm. And then the second part of that question was what catches people out. I would say it's the stamp duty.
Okay.
When you're doing your budgeting, so when you've got those spreadsheets out and you're doing your sort of income and outgoings, and then you start looking at buying, you're going to have all the fees that I've listed, your broker fee, your reservation fee, your legal fees. The stamp duty is not part of the legal fees. It actually, you pay it to the solicitor, but it is a separate fee that you have to budget for. The solicitor will calculate the stamp duty and advise you of what is payable, as the broker should also tell you roughly how much stamp duty you're going to be paying as well.
There's some nuance around like types of when you pay it, whether you'd pay it at the start or later on in the journey.
Yes, so with shared ownership, because you're buying a share, right?
Yeah.
Let's say for argument's sake you buy a 25% share, you may not be you might be exempt from paying stamp duty because it might be under the threshold. Mm-hmm. Now, if you are under the threshold, the solicitor will say, well, you don't have to pay any stamp duty now, but if you want to, you can pay the stamp duty on the full market value of the property, and then that way you'll never have to pay it again if you decide to buy more shares in the future. And there are some occasions where that works well. So if you're buying a large share, for example, when you think that you're going to be staircasing in a very quick space of time, in a short space of time is the word, then you're going to probably want to pay it, because if the value of the property goes up in a rising market, stamp duty is going to go up, right?
Yeah, of course.
Likewise, if they've got a stamp duty holiday or there's any first-time buyer reliefs that are currently running, then it makes sense to make
Jump
use
on
of
it.
them at that time.
Okay, brilliant. Thank you.
While we're on the subject of outgoings, how do things like debt, so credit commitments, loans, credit cards, student loans, how can things like that impact the mortgage affordability assessment?
Very much so, very much a big part of it. So that initial assessment as well as the mortgage. So as we mentioned, it's a two-part assessment. So when you do your initial assessment, the broker will take into account the overall amount of credit commitments you've got, whether that's loan, credit card, student loan, even a pension contribution can factor into your affordability. Now, when you're doing your spreadsheet, I love a spreadsheet, you can tell, right? So when you are doing...
Sponsored by spreadsheets.
Yes. When you are doing that, it is that credit report. I remember at the beginning, get a copy of your credit report. We recommend Check My File. And I'm not sure if I'm allowed to promote them, but
I don't have any problems with that. Is there other providers as well?
Yeah, so the likes of Experian, Equifax, ClearScore, and so on.
Yeah.
But the reason why I recommend and always direct people to Check My File is because it's multi-agency.
Okay.
It captures every single credit provider and pulls it into one report for you.
Cool.
So you have a look, and what I would say you're looking for is make sure every credit card, every outgoing is listed on your spreadsheet, so you know the total amount of credit commitments. If you've got loans, we want the monthly amount that you're paying out each month. But then also looking out for what we call adverse credit. So if you've had any missed payments or defaults or CCJs, anything like that you see on that credit report, people worry about the number of how much debt they've got. They don't worry about, I've had a missed payment, or that was 3 years ago, or that was 5 years ago. It doesn't matter. All of these things will have an impact on what type of mortgage you're able to obtain.
Okay.
With the legal aspect, obviously it's a big part of buying a shared ownership property. What are some kind of key questions you think buyers could ask their solicitors to really help them during the process?
I would say, and I've got to throw this in because there's a lot of press about service charges and shared ownership, and a lot of negative press about shared ownership. I would say ask the solicitor for a breakdown of the service charges if they haven't sent it, and then for them to explain it in layman's terms, probably in an email, as to exactly what the service charge covers, explain to them how it's going to be reviewed. And I think that way there will be no nasty surprises, because I appreciate most people, even buying on the open market, when you buy a property, you get a lease through or you get the contract pack through, it's a lot of paperwork, it's a lot of reading.
It's a lot.
I want to go through a little bit about the process. So let's say you've reserved the property, you're then in the process of submitting the application. What happens from there?
You're talking at the mortgage application stage?
Yeah.
So dependent on who you buy through and which broker you use, or whether you go direct to a lender, the journey will be slightly different. So I'm talking from a Censeo perspective here. So we will always allocate you a dedicated case manager. So for example, it might be Mercedes, and she would submit the application to the lender, send you a copy of all the documentation that's required, a bit of a welcome email, confirm that she's your case manager. The application then is what they call underwritten by an underwriter at the lender. Different banks and building societies have different timescales. So the case manager will let you know roughly how long it's going to be for that initial underwriting to take place. And when I say initial underwriting, it just means that they're going to look at your documents, your pay slips, your bank statements. They're going to do their initial check to make sure what we've put on your application form is correct.
Yeah.
Do they like the application? Is there anything on the application that they think is outside of their lending criteria? So they'll come back and they'll say, yes, we've looked at the documents. This is all fine. We'll instruct a valuation. We're going to get a surveyor to go out and value the property. They might say, in the meantime, we also want to see an additional pay slip or bank statement to cover X or Y, because they might pick up something in your bank statement that they want further clarity on, for example.
Yeah, okay, yeah.
Or they might say, you've uploaded 3 pay slips, we would like a further 3 just to see, there's overtime. So we want to see more
evidence.
More evidence of
regularly
the overtime
get that
to see if it's more sustainable, for example.
Yeah, okay.
So there's always documents they potentially might ask for, or they might even ask to upload your copy of your passport, certified ID, because it's not something that's standardly asked for, certified ID.
Okay.
A lot of the time, electronic verification is done on ID. So initial underwriting's done. They might ask for further documents. A valuer goes out, does a valuation. Once the valuation comes back, they then need to review the underwriter, the valuation report. So that report is there for the lender. It isn't for the purchaser. So that lender gets the report to tell them, is the property worth what we've said? So if we say it's worth 500,000, is it worth that amount?
Yeah.
Valuer says, yes, it is, in my opinion. Is it mortgageable in the sense of, is it standing? Is it a property? Because what lenders are looking at is risk.
Yeah.
That's their security. Because what they're looking at, which he's talked about, the parts that we don't like to say, they're thinking, if I need to repossess this property, if this person doesn't pay, are we going to be able to sell it on?
Yeah. For what? For the same price?
Are we going to get our money back?
Yeah. Okay.
Because is it marketable? Is it desirable? Is it somewhere where people are going to want to buy and live? Mm-hmm. And that's essentially that part. The valuation comes in. That's all good. You get a green light there. As long as they're happy with all the documents, a mortgage offer is then issued. We then send the mortgage offer to the purchaser and the housing association. The solicitor gets a copy automatically, directly from the lender. So we don't send it, or the purchaser doesn't send it. The lender will send a copy to the solicitor that's acting for the purchaser. The purchaser then essentially will speak with the solicitor at that point. If there are any questions, so this is something that comes up that people are not aware of. So the lender also has their legal work done by your solicitor as the purchaser.
Okay.
So that the lender acts for the solicitor acts for the lender. So the lender might have questions about the property, for example. They may have questions about the lease. So they will then ask your solicitor to satisfy those questions. Once they have been satisfied, essentially deposit monies are sent to the solicitor. Exchange then can be done. So when you exchange contracts, that basically means you're signing your life away for that mortgage and that property. And you're legally essentially tied to complete on the purchase.
Yeah.
And then complete. If the build is ready, then you set a completion date. If it isn't ready, then the housing association or developer will let you know when they're expecting completion.
So if you do get the mortgage offer out, and say it's been out for 3 months, but then interest rates come down, are you tied in at that higher interest rate? Do you have any kind of options to maybe get on a lower one?
Good question. As long as you haven't completed, in theory, when I say completion, so lenders release the money to your solicitor, you can change your mortgage product and the mortgage offer. However, I will caveat that with this. The lender has the right at any time, if there's any material change, to rescind your mortgage offer. Now, if you go in and say to them, actually, I want to change the offer, I want to select a new product, they may re-credit score the application. Now, your credit score, let's say to meet the lender's credit score, you needed to get an A credit score, or let's do numbers, you needed to get 300 points. And they re-credit score you some 5 months later, and your score is 298. Computer might say, unfortunately, you failed the credit score. There is no guarantee that they will honour the fact that you had an initial offer.
Okay.
Bit of a gamble.
I think that's leading us perfectly into our next section, which is some myth busting. So in this section, we're going to watch some videos that we shot at the last London Home Show. And we asked guests to the London Home Show, what has your biggest hurdle been to getting onto the property ladder or buying a home? So premise is we're going to play some clips, we're going to listen, and we're going to react afterwards. We're going to have a chat through what's been said.
Sounds good.
Cool. All right, let's fire up the first clip.
Probably saving for a deposit, because that takes a while.
Do you rent at the moment?
Currently living at home, so yeah.
Okay, so saving up that deposit is the biggest challenge.
I think that's quite a common one, quite typical at the Share to Buy show and just generally in the housing market. I think across the country, quite frankly, for especially in the cities, people can't save. that lady is living at home, so obviously
Her
it's
parents
easier.
are charging her too much rent. That's what I reckon.
Yeah.
Quite possibly. Yeah. So if she does listen to this, Mum, you get that rent down.
If you're out there,
What I will say is that shared ownership is easier than obviously buying on the open market, because typically you only need 5% of the share value.
yeah, so it's a much smaller deposit to begin with,
It's
isn't
a
it?
lot smaller.
Right, let's have a watch of the next one.
Nobody wanted to give me a mortgage, and I didn't really appreciate that having 10% just wasn't going to be enough.
Yeah, sure.
And that was just my biggest shock. But yeah, buying a loan was the biggest issue.
Okay, so she's talking there about open market, isn't she? Really, I would imagine.
Yeah, it sounds like it.
'Cause she's talking about like having more than 10% and stuff like that.
It does depend though. Everyone's circumstance is different, and this is the problem with affordability, and this is why I always encourage people just to get assessed, right?
Yeah, it's no one size fit all.
No one size. So she may have been told that she needs a 15% deposit, but it might be because of her circumstance. She might be told that she needs 25%, but it just depends on what she's looking at, whether or not she's been in the UK for X amount of time. Because, if you're not in the country, or if you're on a visa, for example, that might impact your deposit. If she's self-employed, if she's in a fixed-term contract. So there's so many
She
variables.
changed job roles a lot and stuff like that. Yeah.
So many. Or it just might just be affordability.
Yeah.
Because what you want, a 10% deposit, you're not going to be able to get a loan for that amount.
Okay.
So it needs to be more.
So we've spoken about shared ownership being really good for those struggling to save a deposit. But while we're also looking at the affordability side of things as well, I suppose the income wouldn't need to be as high as it would for the equivalent open market property at the same, value price.
Correct, yes, because the share is only 25%, for example. So the mortgage that you need to get, if it's a £400,000 property, 25%, £100,000 share. If you're putting down £10,000, you only need to get a mortgage on 90, rather than if you're buying it on the open market, it's £390,000 you need that mortgage on. And if we say that a lender will lend between 4.5 to sort of 5 times your income, that's a significant difference, isn't it? So,
and is it assessed differently with like employed income to self-employed income?
It is. So depend on how you're self-employed, because some people could be a limited company. So if you're a limited company, what they're looking at is your salary, if you pay yourself a salary, and any dividends that you draw. And typically they want to see at least 2 years. There are some lenders that will take 1 year, but that is limited again. If you are a sole trader, we are then looking at net profit that's declared and you're paying tax on. Again, ideally the last 2 years, and it's typically the average of the last 2 years that is taken. Again, lending criteria varies, right? So there are some lenders that may look at the latest year if you can show that it's increasing every year and it's a business that they understand and they can see that it's a growing trend, that they may take the latest year if it's higher. But ultimately, if you're self-employed, you're looking at the last 2 years figures, limited or as a sole trader. But the key thing is always the net. It's not the gross. And that's something that happens quite a lot.
Okay.
When people fill out forms, if they're self-employed, they might write, my turnover is 50,000. But that's not what the lender's interested in. They're interested in what the actual net profit is.
Yeah, okay.
Which is interesting because like employed income, you always look at the kind of gross annual
Exactly.
salary, don't you? So like, you can
Exactly.
see where the confusion comes from.
It is. But if you think of it, your net pay when you're employed is what goes into your bank account. That's what you've actually earned.
Right, so that leads us on nicely to the final part of the podcast, which is the nest egg section. So what is your nest egg, your one crucial bit of information that you would give to a first-time buyer?
I would say preparation is key. So do your research. So get your documentation together, like I said earlier. Research the areas that you want to live in. Get your numbers together. Know exactly what your budget is. That will enable you. Once you start speaking to the professionals, it'll put you in a lot better stead. You also know what they're talking about, and that will help you.
No, that's brilliant.
Amazing.
I think a key takeaway for me from everything you've said, Anthony, is probably getting your credit score. That'd be
Get
like
that credit report.
get that
That's just what I was going to say.
Oh,
I was thinking, you know what, I've got one that
takeaway.
Rob would never say. I'm going to talk about the credit score.
Sorry.
Straight in
Sorry,
there.
mate. Well, it shows it's just such an important
It is an
takeaway.
Can I
important
just
part of
say
it.
it's the credit report you want
The credit
over and
report.
above the score?
Just the, not just the score.
The
The actual
report's the
full
key.
report.
Yeah.
I'm going to come up with a different one then. So I'm going to mention about the two separate kind of affordability checks that take place with shared ownership. You know, you're not only trying to make sure you can afford the mortgage, but you're also, you know, making sure the housing association are okay with your income as well. So yeah, two forms of affordability checks. So it's really important to get everything prepared as early as possible.
Definitely. I think with that check, just with the housing association, bear in mind they're looking at, do you earn enough, but also making sure you don't earn too much.
Yeah.
Yeah. A running key theme of all of these podcasts is preparation is key, really.
It really is.
That's the major takeaway from all of them. So, well, I think that's about all we've got time for today. So thank you so much for joining us, Anthony. I hope you've enjoyed yourself.
It's been good. Thanks for having me.
If you want to listen to more of our Shared Ownership Unpacked, please head to wherever you get your podcasts.